There are two strategies to increase your earnings. You either work for your money or it works for you. Rather of storing money in a bank account with low interest rates, you might see it increase by investing properly. Investing normally does not provide significant profits immediately, but if you are willing to play the long game, there are benefits in store. It is preferable to your money losing value over time or, worse, being squandered. Hello and welcome to Invested. If you're thinking of investing your money but you don't know where to begin, then stay tuned, as this video will tell you everything you need to know to get started. Before you start investing, you need to figure out why you are investing, what sort of return you were expecting, and what level of risk you are willing to be exposed to. This will help the brokers to put forward options that suit your mentality. Number 1. Choose between brokers and robo-advisors. Brokers might be full-service or low-cost. Full-service brokers provide a complete range of traditional brokerage services, including financial counseling for retirement, healthcare, and all things monetary. These brokers usually charge a lot, and they prefer taking clients with greater net worth. On the other hand, many discounts online brokers offer a set-it-and-forget-it robo-advisory service, which allows you to choose and place your own transactions. In comparison, robo-advisors enable investors to save money by using technology to reduce costs and expedite advice for investment. Number 2. Minimum requirement for account opening. A minimum deposit is required by many financial organizations. Unless you deposit a particular amount of money, your application will not be accepted. Before determining where you want to open an account, do some research and read our broker evaluations. Minimum deposits are listed at the start of each review. The minimum deposit requirement depends completely on the company. There are some without any minimum deposit requirement, while others may charge you often to cut costs, such as trading and account administration fees if your balance exceeds a specific threshold. Others may provide you with a specific amount of commission-free deals just for signing up. Number 3. Broker's commission and fees. Usually, your broker will charge you a commission every time you purchase or sell stock. Normally, the trading commissions start at $2 per trade and can go up to $10 for some bargain brokers. Some brokers do not charge any trade commissions, but they compensate in other ways. Stock investing can be expensive if you jump in and out of positions frequently, especially if you just have a limited amount of money to invest. If you want to buy 5 different stocks at once, this is considered 5 separate deals, and you will be paid separately for each one. Let's say you decide to invest $2,000 in the stocks of those 5 companies. To do so, you'll have to pay $100 in trading fees if the amount is $20, which is 5% of your $2,000. After trading expenses, your account would be reduced to $1,900 if you invested the entire $2,000. This equates to a 5% loss before your investments even begin to earn. If you sell these 5 stocks, you'll have to pay the trade expenses again, which will be another $100. It would cost you $200 to make the round trip, buying and selling, on these 5 stocks. Number 4. Costs associated with mutual funds. When investing in mutual funds, an investor will pay a lot of fees, such as the management expense ratio, MER. The larger the MER, the greater the impact on the fund's total performance. Then there is also a sales charge known as loads, which are of 3 types: front-end load, no load, and back-end load. When opposed to stock commissions, mutual fund fees are really an advantage for new investors. This is due to the fact that the costs are the same regardless of the amount invested. Use the dollar cost averaging method and invest with as low as $100 a month. Number 5. Tight budget. Invest through your employer. If you're on a limited budget, put 1% of your salary towards your company's retirement plan. Contributions to work-based retirement plans are deducted from your paycheck before taxes are calculated, making the payment even less painful. If you're happy with a 1% contribution, you can gradually increase it as you obtain annual raises. The extra contributions are unlikely to go overlooked. If you have a 401k retirement account at work, you may already be investing in your future with mutual fund allocations and even stock in your own company. Number 6. Stock market simulator. A stock market simulator can be a useful tool for people who are new to investing and want to get experience trading without endangering their money. Many different trading simulators are accessible, both for free and for a price. Stock market simulators allow users to invest in a portfolio of stocks, options, ETFs, and other securities using fictitious money. They track the price changes of investments as well as other significant variables such as trading costs or dividend payouts. Investors make virtual trades in the same way they would if they were investing real money. Users of the simulator can learn about investing through this process. Number 7. Reducing or diversifying your risks. Don't put all your eggs in one basket. Diversifying your asset is the only thing that comes without a cost. Diversifying your assets reduces the chance of a single investment's poor performance negatively impacting your overall investment return. That's why ETFs are great for stock market beginners and experts alike. They're relatively inexpensive, available through robo-advisors as well as traditional brokerages, and tend to be less risky than investing individual stocks. An ETF, or exchange-traded fund, is a financial product usually structured to mirror a specific segment of the market, often indices. They can contain stocks, bonds, commodities, forks, and more, and are used by investors to diversify their portfolio. Number 8. Risk and return associated with investing. Being a wise investor, you should have a thorough understanding of your risk tolerance. Certain financial products, such as equities, carry a higher risk than others, like bonds. This is due to the fact that there is no certainty of profit when purchasing shares. A company's stock can drop if it performs poorly or loses popularity with investors, and you could lose money. Government bonds and certificates of deposit, for example, are considered secure investments, but the return on them is significantly smaller. Achieving the correct balance between risk and reward is a crucial principle of investing. A diverse, well-balanced portfolio should include both low-risk and high-risk investments. Number 9. Do your homework. With all the basic knowledge in hand, it is now your responsibility to compare commissions to those of different brokers after determining the minimum deposit requirements. Be more focused while selecting the investment you'll make and get in-depth knowledge about the restrictions you tend to face as an investor. Number 10. Factors to consider. Few factors should always fall under consideration while investing in stocks. These include your current age, your earnings, financial goals you tend to achieve, how much risk you can tolerate, and lastly, your time horizon. People invest for a variety of reasons, such as to purchase a home or to set up their business. Then there are also those who want it for their retirement, and investing now can help provide you with that financial security for when that time comes. So that is all for today, folks. Thank you for watching Invested, and I hope you enjoyed this video. Do not forget to subscribe to our channel and do hit the bell icon on your way out. See you all next time.